Investing, a term that's become increasingly popular over the years. Today, we're going to break down the differences between index funds, ETFs, and mutual funds, and help you decide which might be right for you. This is Foxfire Finance, and we are committed to spreading the great news and concepts of the FIRE movement to anyone dreaming of a better life. We aim to help you achieve your goals by providing meaningful tips and strategies that will bring you closer to your dreams of financial independence and retiring early. But first, don't forget to subscribe, burn the like button, and ring the notification bell to be updated on our latest releases to guide you on your way to FIRE. Let's start with mutual funds. Imagine a bunch of folks throwing their money into a big shared pot. Now, instead of this pot being used for a giant pizza party, it's used to buy a mix of things like stocks, bonds, and other financial goodies. This way, everyone's money is spread out, dabbling in a little bit of everything. It's like creating a financial mixtape with everyone's favorite tunes. So there's a bit of diversification, and not all eggs are in one basket. This pooled approach helps share the risk and potential rewards, so you're not just banking on one thing but a whole collection of assets. This diversification is a key feature. Think of it like not staking your entire fortune on the outcome of a single effort. In the context of mutual funds, this principle shines bright. Rather than committing all your resources into one specific stock or bond, which can be quite risky, mutual funds allow for a broader distribution across multiple assets. It's similar to diversifying your portfolio, much like a connoisseur would select an array of wines for a collection. This ensures that if one asset underperforms or faces a downturn, others in the portfolio can potentially offset that dip. It's a strategy that not only spreads the risk, but also offers a level of protection against volatile market swings. It's a refined approach to safeguarding one's investments. Now let's move on to ETFs. What are they? Exchange-traded funds, commonly known as ETFs, represent an intriguing facet of the investment arena. On initial observation, they bear a resemblance to mutual funds, given that both pool together assets from a myriad of investors to invest in a collection of stocks, bonds, or other securities. However, here's where the distinction emerges. ETFs are listed on stock exchanges and are traded, much like individual stocks. That means that throughout the trading day, their prices can fluctuate based on market demand, unlike mutual funds which have their prices set just once at the end of the trading day. This unique feature of ETFs grants investors the flexibility of real-time trading combined with the diversification benefits typical of mutual funds. Thus, while they share foundational similarities with mutual funds, ETFs offer a distinct blend of features that sets them apart. Like certain investment vehicles, ETFs are traded directly on stock exchanges, mirroring the behavior of individual stocks. This characteristic imparts a distinct advantage. During the established trading hours of the stock market, investors have the liberty to purchase or divest their ETF holdings. The flexibility is similar to how one would transact shares of a particular company on the exchange. In essence, this provides potential investors with both the advantage of real-time price adjustments based on market dynamics and the opportunity to react swiftly to financial news or economic indicators. In short, with ETFs, not only do you gain diversified exposure similar to funds, but you also benefit from the transactional freedom that comes with stocks. It's time we talk about index funds. Diving into the investment world, we bumped into something cool. Index funds. Think of them like a mirror. Instead of trying to be the star of the show, they want to reflect what's already out there. Take the S&P 500 for example. It's like the big league chart for top US companies, and index funds try to mimic its moves. Now, while some fund managers are out there trying to play the market's game, making wild moves to get ahead, index funds chill in the back seat. They're not trying to outdo anyone, they just go with the flow. This laid-back vibe is called passive management. What's so cool about this? Two things. One, because they're not making all those frantic trades, the fees are way lower. Big win for your wallet. And two, since they're just copying the top charts like our buddy the S&P 500, their performance is kind of predictable. They're not chasing the next big thing, they're just sticking to the script. So if you're looking for a mix of saving cash and getting steady vibes, index funds might just be your jam in the investment world. Now, before you choose the fund you would like to invest in, be sure to do these things beginning with number 1, comparing costs. When it comes to investing, costs matter a lot. So let's break down how different funds stack up on the price tag. First up, index funds. They're like the budget-friendly option in the investment world because they're just trying to match the market, not beat it. No fancy moves, just following the lead of big indexes like the S&P 500. This follow-the-leader approach keeps costs low, meaning less money out of your pocket. Now, mutual funds, especially the actively managed ones, are a bit more high maintenance. They've got fund managers constantly making moves, buying this, selling that, all trying to outsmart the market. For their expertise and all that hustle, you pay a bit more. Then there are ETFs, sitting comfortably in the middle. Their costs vary, but a big influencer is how much they're traded. They're not as laid back as index funds, but they don't always come with a higher price tag of some mutual funds. To sum it up, index funds are like the no-frills economical choice. Mutual funds can be the high-end pricier option, especially when actively managed. And ETFs, they're in the middle ground, with costs often depending on their popularity in trading. Know what you're getting into and choose what fits your budget and style. Number 2, flexibility and trading. When it comes to flexibility, ETFs take the crown. Imagine a dance party and ETF is the fund that dominates the dance floor. That's because they can be traded all day, every day, moving with the rhythm of the market's ups and downs. On the other side of the room, you've got mutual funds and index funds. They're more like the folks who wait for that one perfect song to dance to at the end of the night. They only trade once a day. When the market's big party wraps up and the lights come on, meaning the market closes, that's when they set their trade price. This special price they dance to is called the net asset value or NAV. So why does this matter? If you're someone who likes to move with the moment, maybe make quick decisions based on how the market's feeling right now, ETFs give you that freedom. You can jump in or out anytime during the trading day. But if you're more about the slow dance, taking things one step at a time, and you're okay waiting for the day's end to see where things stand, mutual or index funds might be more your speed. In the grand dance of investing, ETFs offer that constant beat and flexibility, while mutual and index funds take a more measured approach, waiting for the day's final note to make their move. Number 3, tax implications. Imagine comparing ETFs and mutual funds to how we handle dining bills. ETFs are like those dinners where everyone pays exactly for what they ordered. Their setup is geared towards giving investors a predictable experience, especially when it comes to taxes. Now, think of mutual funds as sharing a meal. Even if you just had a small appetizer, if someone else goes all out on a lavish main course, everyone's share of the bill goes up. In investment terms, if some investors in a mutual fund sell their shares, you might end up with an unexpected tax hit even if you've been holding steady with your shares. To put it simply, ETFs are the clear-cut you pay for what you get option, offering predictability in costs. Meanwhile, mutual funds have this communal aspect. Your financial outcomes can sometimes be influenced by other investors' moves. Number 4, minimum investment. Starting out small, ETFs could be your ticket in. The cool thing about them is that many don't have minimum purchase requirements. You can hop in with whatever you're comfy with. On the flip side, mutual and index funds sometimes have a buy-in price, kind of like a cover charge at a fancy club. They might ask for a specific amount upfront to join the party. So if you're working with a tighter budget or just want to dip your toes, ETFs might be a more flexible starting point. Number 5, dividends. Got a thing for dividends? Let's chat about how different funds handle them. Mutual and index funds, they're like your friend who immediately invests any extra cash into a new venture. When these funds get dividends, they often pour them right back into the fund. This can give your earnings a little turbo boost because that reinvested money can start earning too. Now, ETFs, they operate a tad differently. Picture them as that buddy who, when they get a bonus, throws a mini party and shares it with everyone. ETFs typically distribute their dividends straight to you, the shareholder. It's like getting a little thank you note in cash form for being part of the ETF club. Mutual and index funds reinvest and potentially grow your money faster, while ETFs give you a direct slice of the dividend pie to enjoy as you please. So, which one should you choose? Navigating the investment landscape can often feel like selecting the right tools from a vast toolbox. Each tool has its unique strengths tailored to specific tasks. If real-time flexibility and the ability to make intraday trades appeal to you, ETFs might be your instrument of choice. They allow for dynamic decision-making in tune with market fluctuations. On the other hand, if you're drawn to a more hands-off, cost-effective approach that closely mirrors market trends without much interventions, index funds might align with your preferences. They're designed to passively follow market indices. Lastly, for those who appreciate the expertise of professional managers overseeing their investments, mutual funds offer this curated experience. These funds employ experts who strategically buy and sell assets with the aim of outperforming the market. In summary, for active trading, consider ETFs. For a passive, cost-efficient approach, lean towards index funds. And for expertly managed portfolios, mutual funds might be your best bet. Regardless of your investment choice, it's essential to ensure that it syncs up with your financial objectives, the level of risk you're comfortable with, and the time span you're looking at for your investment. Making sure these elements align can set the foundation for successful investing. Did you find this video helpful? If this guide lit the spark for your wealth journey, then burn that like button and don't forget to subscribe to our channel for more tips on how you can reach your financial goals. Until next time, we are Foxfire Finance and keep that fire burning.